Alright, so you have once entered a trade, and after entering that particular trade, you'd see the market go straight in that particular direction you've entered, and then later to see it after taking your stop loss, return and go to the intended direction. If you have actually faced something like that, then this video is for you. Make sure to watch up to the end so that you fully comprehend how to dodge those bullets. Alright, so what are trap points? This is what we will actually discuss more about in this video. These are market manipulations that are there and that are responsible for most of the money that you have lost. So these are points where the market makers issues an enticement. You are enticed to take a trade, but they are not yet ready to go in the particular trade that you have taken. So this enticement will be to change direction but continue going in their original direction or vice versa. These points usually leave your trade and go straight to your stop loss. So let's talk about the simplified support and resistance. This is resistance, this is support. When the market is actually coming to the resistance point, you'd find out that at this particular point, they actually put candles that entice you to take an opposite direction, which is downwards. But later, you'd find out that they will actually go straight above and later go down as you intended. So this enticement is actually done to trap you so that you take the position prematurely before they are done with whatever that they are doing. So if that scenario happens, we say that you have been trapped because price will never come back to your entry up until they hit your stop loss, or if you remove the stop loss or let the trade run openly up until they take out your whole account. So how do you identify these points where they make these evil tactics? Let me show you first where they do so and explain how you can dodge those bullets. So step one is always to know and understand the regions of traps. So firstly, to know the manipulation, you need to understand where it is done. Market makers have four entry points, and that is where they trap you. These are 1, trend reversal points, 2, book and continue points, 3, book and continue points, 4, original trend reversal, as I will show you right now. So this is the illustration of the market maker cycle, which is the model that we all use. Even in the course that I teach, the top 1%, I have done and I found a very perfect way to identify this with high accuracy and without any counting of levels and so forth. You actually see it right in front of you. Just check the course right in the description box below. All right, so this is the trend reversal. As you can see, there was a prior trend from this particular side, then a book and continue. By book and continue, we mean this is a point whereby they take some of the portions within their trades and then they continue. Same applies to this one. And then this is the original trend reversal point. So how do they do those traps within these particular points? When they reach this particular point, they usually issue what we call a double bottom, or basically a W pattern. And within that W pattern, you'd find out that there will be the first leg, and on the creation of the second leg, that is where they trap traders. Reaching this particular point, you'd find out that they can actually issue a few candles to entice you to go long, but later to see them go right below the first leg that you intended to reverse from. So that is the first point. They actually use traps to entice you to get into the market before they have planned to ultimately reverse the market. Same applies at this particular point. You'd actually expect them to give you something like this and continue. They'll give you those candles, especially during the Asian London session changeover. They'll actually entice you as if the market is already going to the upside, but later you'd see the market going to the downside after you have already entered and your stop loss is already kicked out. Same applies at this particular point, and here is actually another point where they will actually entice you to go right at this particular zone, and later you'd see them do something like this. So whenever market reaches these points that I've shown you, these 4 points, remember they will try to entice you to go in, but they will take out your stop loss. So be wise and do the following stuff. So identifying and avoiding traps at trend reversal points will actually require you to be wise and do these things. You can see that we had these flows to the downside, 3 flows to the downside, and reach a point where we have a probable double bottom. What happened at this particular point? We can see this becoming the first leg, and here there was a green candle. You can see that this green candle was once a bullish engulfing pattern because there was a red and a green that was engulfing this red candle. In that particular case, you can see later when they closed this candle, it was now a wick. There were traders who actually went long at this particular point using this as their reference, and then they put their stop loss right below structure. But what happened? You can see this move to the downside. This is what we call a trap, manipulation trap. So how do you go around this particular way of being trapped? You need to actually follow the rules that I'll just lay for you shortly. You can see here we had a move to the upside, and we reach a beautiful M pattern. But within that beautiful M pattern, we can see on closed candles, there was a beautiful bearish engulfing pattern. But later, I'll actually give you the rules. So here are the rules to avoid traps at reversal points. How do you dodge the bullets that are issued by market makers at these particular points of reversal? So do not enter below first leg, saying that when we have 2 legs that are being formed, never assume that they are going to reverse here or here. So never enter below the first leg. If this is the first leg, do not enter here, right? So always enter after a candle closes above the 13 or below the 13, depending on the market context. If we look here, we can see that the market came back and retested this zone of resistance, and then a candle closure occurred here. When this happened, you'd know that the market is now a low probability of returning and trapping you in this particular direction. And the market actually went to the downside beautifully. So always observe the 13 EMA. And for the purposes of those who do not know the 13, it is the 1 EMA in red, which is this one. So you can simply add this on your charts, having the 13, the 200, the 50, and you can use them as I'll explain shortly. So your stop loss must be under the longest leg and can be determined after the second leg low has been set. Meaning that if we have 2 legs like this, we need to have the levels of those 2 legs set for us to determine the rightful point of stop loss. And the stop loss will be issued above the longest leg. In this case, this is the highest leg, this one is higher than this one. Therefore, we are going to use this one as our reference for our stop loss. In some other cases, you'd find that we'll have something like this, and this being higher, you will actually use that as our reference point. So you can learn these reversal entries in my top 1% traders course, where I explain a high accurate way of catching them. You can check the link that I've left in the description box below and master this particular entry setup. Let's now move to the trend entry traps. So you can see that this is actually the first drop after we have set this particular peak. And after that, we always know that when we are following the institutional market maker method, the market usually return on the 50 EMA, which is the EMA in blue. This is called the M15 home baseline. And when it comes to the M15 home baseline, it usually reverse. However, when that happens, usually traders would love to actually short, or some others would actually set a pending at that particular point, which is wrong and will lead you to being trapped. So if you set a pending here and the candle come and pierce through and go right here, you'd find out that you'd have been trapped. You can see the market later went below the 50. So here are the rules of how you can avoid being trapped when you are in a trending mode. So do not enter a trend entry above 50 EMA. If you find yourself entering a trade right above the 50 EMA in this particular instance, you are doing it wrong, because you are likely to get trapped and the market will likely keep on going to the upside, basically like that. Always enter after candle closes above or below the 13 EMA, while or above or below the 50 EMA. We are saying in this particular case, you need to actually wait for the market to come below the 50, this particular side of the 50 EMA, and you can see this, there was a spike candle. And as a benefit for watching this video up to now, here is actually a small tip. When there is a spike candle like this, when there is a spike candle, usually the following candlestick will retrace to 50% of that spike candle. You can see that this green candle actually retraced to 50% of this spike candle. That is where you would enter, but only after you have determined that we are going in that particular direction due to the candle closure below the 13 EMA. Your stop loss must be above or below the 50 EMA depending on market context. Like in this case, we are saying your stop loss should be on the region above the 50 EMA, basically like that. Learn more on these trend entries in my top 1% traders course, where I also explain it a high accurate way of catching them. I've actually put the link in the description box below. So basically, market traps are designed to manipulate retail traders, but with the top 1% course, you can turn those traps into golden opportunities. On that note, we've come to the end of this video. Thank you for watching. Like and subscribe, and I'll see you in the next one.